Hey guys, welcome back. In this video, let's talk about how I made $10,000 last month trying to sell put option and call option on Tesla. Now in my previous video, I've mentioned that I made a mistake and my Tesla shares actually got called away. And since I'm sharing transparently with you guys, I will share with you how I use options to repair my positions. Now in this video, I will not go down the rabbit hole and do exactly the calculation, but I will show you what is my thinking framework behind my trades. So the situation right now is my shares get called away and I get back cash in return. So with this extra amount of cash, I'm able to sell more put option than usual. Selling put option means that I'm guaranteeing to purchase 100 Tesla shares at said price at said date. For me to be a guarantor of this contract, I will have to bear risks, and these risks are not free, and hence for bearing these risks, I'll be paid a premium. So for last month, I actually wrote 2 contracts for Tesla for selling put option, and that is actually 6 contracts post-split. So 2 contract pre-split, 6 contract post-split. So choosing 2 strike price that is far away from each other gives me the ability to maneuver easier and be more flexible with my options trade. So again, the reason why I sell 2 put option pre-split or 6 options contract post-split is because I want to get back my shares. And I'm not in a hurry to do so because I sense some form of market weakness and I think things will sideways for a while. So I'm not in a rush, but this is just my own opinion and you don't have to follow. I'm just sharing it transparently, and I decided not to post my live trades online because to me it is like navigating the forest in the dark trying to survive, and then you are lighting up a torchlight and all forms of life, predator, prey, all can look at you, and I personally think it is stupid because I've already tried that. I've tried to post transparently every time, and there was actually once that I wanted to short Tesla at $1,200 pre-split. Buy put option. Buy put option is the right to sell 100 shares with a small down payment called premium. My maximum losses are the premium stated. I can close the contract at any time within this time period. I'm thinking Tesla has almost exhausted its bull run at $1,220, and I may be buying put option to protect any paper gains if Tesla has a correction. The higher Tesla goes, the higher odds I will be doing a hedging put. But because I'm a Tesla advocate and there are a lot of people in the Tesla community, I got shot down and people start saying nasty shit to me online and offline, and I decided not to short Tesla because of it. And that is actually a huge opportunity cost. Had I trusted my instinct to short Tesla at 1,200, I would have become a millionaire at 26 or 27. So this is a big opportunity cost, and I decided not to post my trades online again. From now onwards, we will just look at my past trades and we will do a case study on my past trades, what I did right and what I did wrong. So I hope you guys understand. So let's get right back to the topic. The first put option I sold is 780 and the other put option I sold is 830. So 2 put options that have far strike prices from each other, and I decided to sell a call option at 870. Now why did I decide to sell a call option at 870? Now call option is basically offering your shares as collateral. It means that you're willing to give up your shares at the correct price and at a set date. So you choose your own strike price and an agreed upon time frame. So I decided to sell another call option because of a few reasons. Okay, so this call option, I choose the strike price at 870 and I receive a $50+ premium. 870 plus $50+, so we can use the premiums received to offset any losses. And my break-even price is 920 something, and that means if Tesla goes above 920 something, I will start losing money. However, I still have 2 sell put options, and each put option is giving me 4K USD. One is 4K and one is 4.8K if I'm not wrong. So let's say if Tesla go to 92 something, and that is my break-even price for selling call, I will lose no money on selling call option, and I will take full profit from selling put option. I will get 4K USD from selling the 830 put, and I will get 4.8K USD from selling the 780 put. I will get a total of 8.8K USD selling put option, and I will lose no money from selling call option. And this is the strategy I thought of because I feel that things will sideways for a while because there are a lot of macro weakness, supply chain problems, raw material price increases, and production delays. This will definitely eat into the profit margin of Tesla business itself. And on top of that, there is quantitative tightening. Liquidity and credit is going to be sucked out of the market. Multiples of valuations of company will definitely come down. And this is the dilemma I am in. I understand Tesla will grow very quickly, and Tesla is one of the best assets to be invested in this scenario, where this company has low and almost no debt, free positive cash flow, and is growing very quickly. But I think that it's not going to be so simple. Sentiments will suppress Tesla's stock price down, and I'll have time to sell put, sell call. Now let me explain why I sell another call option despite having 2 put options at the same time. I think that this offers me flexibility because if Tesla goes up to 920 pre-split, I will not lose money. I will get full premium from selling put option. Anything above, I will start losing a little bit of money, but I still have my put option to cover my losses. And it is highly likely that I will still make money from selling that call option because I have 2 put options to cover 1 call option. However, if Tesla were to crash, I get to buy back my shares at a cheaper price than what I sold them for, because the put option premium allows me to buy them back at cheaper prices. And if Tesla stock price crash, I'll receive full premium from selling Tesla call option and that is about 5.6k USD for free in 1 month. And I think that this thinking framework and this strategy works for me in my current situation where I have a lot of cash and I'm expecting a sideways movement. Okay, so let me repeat. One put option at 780, one put option at 830, one call option at 870. Should Tesla trade between 830 to 870? Any price between 830 and 870, I get a full premiums from selling 2 put option and 1 call option. And that is about 14k USD, about 19k SGD that I get in 1 month from selling these 3 option contracts. Now of course I'm not a genius or what, sometimes I can't take uncertainty as well. There was a period within the time frame where I'm trading that Tesla shot up to 930, and that got me very uncomfortable because fundamentally I'm a Tesla bull. I have sort of a bull bias towards Tesla. So I did not want to take that risk. When it shot past $900, I decided to close the 780 contract and the 870 call contract together at the same time, so that I only have to deal with the 830 contract. And these two are the result. I'm going to post a screenshot. For the call option, I actually lost 1.6k, and the put option, I gained about 4.6k USD. And I decided to only deal with the 830 contract. However, at hindsight, Tesla actually came down and it traded between the 830 and 870 price range at expiry. So it actually means that if I did nothing for the whole month, I've actually received 19k of free cash for doing nothing. But because I decided to be head itchy and I can't take uncertainty sometimes, I lose the potential for $9,000 upside. So this is the story for my last month. Currently, these are the options trade that I'm trading right now. This options contract is post-split and it follows a similar strategy to my last month. As of now, I'm building up cash flow, storing cash in my war chest that I have not deployed into my investment account. This cash that I am building up will be used to buy leap options on Tesla should Tesla falls to a very attractive price. If I feel that things are not going to crash and things are going to be sideways for a long time, I will do a long dated sell put option with a high strike price so that I capture the upside or I receive the premiums for free. Even though the contract can be 0.9 or 0.8 delta, it means that $1 change is 80 or 90 cent change. It is okay for me because I can use the same capital to sell 2 times the shares than outright just buying and owning the shares. So this is my thinking framework. I'm just sharing with you guys. If you guys find this video helpful, do give it a thumbs up. Subscribe to my channel if you haven't. Thank you, and I'll see you next week.
I can feel the blood creeping up from the heathens. Got will, got fight, got pride, got reason. If they